Morning. Welcome, everybody. And thank you for coming to this discussion on leveraging sustainability to create value in private markets. We've been working on this topic for some time now, and this has generated quite some excitement, so we thought, why not discuss it in a bigger forum here? PRI firmly believes that financial value creation and sustainability are not at odds with each other. And within financial markets, we feel private markets are uniquely positioned to create value for investors, portfolio companies, and the society as a whole by integrating sustainability considerations and strategies across the whole investment life cycle, pre-deal, post-deal, exit, and even afterwards. Private markets has long prided itself on its unique ability to use the tools of stewardship and capital allocation more effectively to bring insights, operational and financial excellence at portfolio companies. However, and unfortunately, many private market investors do not yet know how to create, identify, and capture that value. The business case for sustainability exists. There are enough academic studies showing that sustainability-related stocks outperform. LPs are making ESG a priority. End users and consumers are asking for sustainable products and also increasingly willing to pay more for it. PRI is leading a project on this topic together with Bain, whom you'll hear to speak next, and NYU Stern. And our intention with this project is to create awareness and dialogue amongst investors, while at the same time providing a holistic framework and tools for value creation. Before I hand over to the next speaker, I would like to open a very quick poll to take the temperature this morning. If I may have the first poll on the board, please. Just to understand where you all are and where your firm is on its sustainability-linked value creation journey. And whilst you're responding, I would like to invite the next speaker, Daike Deers, on stage. Daike is a partner at Bain & Co. and at ESG and sustainability team, and she'll speak to you about the project we are working on, as well as share insights based on her experiences. Thank you. Daike.
Perfect. Good morning, everyone. Very pleasure to be here today and talk to you. Thank you, Aditya. Thank you, PRI, for inviting me to speak. And thank you very much for the thoughtful collaboration that we're very excited about. My name is Daike Deers. I'm a partner in our sustainability practice. I work with financial investors on integrating ESG along the life cycle. I also co-lead our pro bono efforts as we support the SMI and ICI on the PMDR, so the Private Market Decarbonization Roadmap, that hopefully many of you have heard about in the past couple of days as well. Over the next 20 minutes, I like to keep it engaging, so please have your mobile phone still open, and there will be a couple of Slido questions. And I like to have a dialogue with you a bit about how we can link sustainability to value creation and how we all can drive this with our portfolio company. And potentially we have some volunteers in the room as well who like to share some own experiences as well. So I'll cover the what a bit. What is it actually that we're talking about? And then I go into the how. I'll brought you two case studies out of two different industries that I like to dive into with you. So what's the what about sustainability? We strongly believe that it can be a core differentiator to your portfolio companies as you engage with them throughout the value creation process. And there's lots of different topics can drive value from sustainability. If we try to bundle them, we probably see 5 buckets that come out: market share, talent engagement, cost leadership, cost of capital or access to capital, and then risk mitigation and regulatory resilience. And all that together can drive better outcomes. So societal and company impact, it can drive value creation for your internal as well as for your external stakeholders, and ultimately drive the returns that we're all looking for. But that's a very abstract concept, so let's unpack those buckets a bit. And of course, we're all financial investors here in the room, so we like EBITDA bridges. So I brought you an imaginative bridge that you see actually there on the slide. And there's a couple of parts that bring you to the EBITDA impact that sustainability can have, right? And if we start with the top line, so all the way to the left, what are the top line levers that we see when we work with companies and financial investors? There's a lot about what you can do with your existing products, but also starting new sustainability products and offer them to the market. And actually, there's a lot of research out there already that you can achieve price premiums depending on the industry that you're in. Actually, NYU Stern just published a paper where they saw a 25% price premium for sustainable products in CPG in the US. So I think there's a lot of nice examples of that, and I think that's probably one of the first things that you think about. The third point here is around higher talent engagement and franchisee engagement or other internal stakeholders that are important to drive your business outcomes. And sometimes that's forgotten. So I like to put a bit of emphasis on that, given, and in fact, then we work with EcoVadis a lot, which is an ESG rating provider. And we did some research to actually correlate ESG outcomes with financial returns. And that what we can see here is actually that top quartile companies that perform highly on employee satisfaction. So those that are top quartile employee satisfaction versus those bottom quartile ones on employee satisfaction actually see 6 to 7 percentage point higher EBITDA. So I think as we all believe and think through that employee engagement is great and important, there's actually now also some data to support that. After top line, of course, there's bottom line levers. There's a lot about what you can do to reduce costs and improve your bottom line. We see that carbon leaders also have 4 to 5 percentage points high EBITDA to obviously significant energy cost savings. And you can achieve that through green infrastructure, dematerialization, plant optimization. I think that's probably also a long list that we all have ready to engage with our portfolio companies. And this all leads to the EBITDA that we see that's quantified. Of course, all that doesn't come for free. There's CapEx investments and requirements that you need to think through as you think through the business cases for those levers. And it's important to look holistically at those levers. So, but what's on the right-hand side? I think we believe there's more to sustainable linked value creation than just to quantify levers that are important. But I think there's more also on the risk mitigation side and actually multiple optimization that you can think through and ideally should think through and make that second nature as you engage with your portfolio companies. If you think about future-proofing the business, I mean, there's a lot of trends and disruptions that really can disrupt your business model. If we think about EV, what EV is doing to the automotive industry, if you think about the transition that some of the energy companies are going through, I mean, there's a long list of examples, but there are also smaller disruptions. So it's important to think through and help your portfolio company what could be the disruptions that are shaking up their business model. And also not only the business model, but also future-proofing what customers expect. And here, we actually did a recent study and asked 500 CEOs, also in the B2B environment, what they see, how they see customers shifts happening. And even in a B2B setting, we see that 1/3 of customers would actually shift their suppliers if the sustainability requirements are not met. And in 3 years, that would be 60%. So it's quite real. And if you don't future-proof your business, if you don't think about how you can decouple your supply chain from scarce resources and the like, and better serve the customers, that's probably could be quite challenging for you. Then I think, of course, there's reputation, there's enhanced customer trust through disclosure. We talked a lot in the conference about disclosure and having the right data. There's also benefits to having that with your customers. There's obviously regulation in many jurisdictions as you face carbon taxes and the like. It's good to get ready and be ready for those. And then last but not least, of course, access to capital. We are in this room, we all know that there is a pool of capital that you can tap into, and potentially on top you can link your loans actually to KPIs on that regard. So I think that's a bit of the lay of the land if you think about what it is. I would actually like to ask the room and get Slido up again. And actually when you think about how you engage your portfolio companies, think about your portfolio. What are actually some of those top sustainability topics that you see that drives value with your companies? And of course, that's a bit dependent on the sector that you invest in, but it would be very curious to see what's coming out. And there's a long list around environmental, social, and governance levers that we put in you as an option. So hopefully there will be some that you find interesting. We'll give the room a bit of time. But it's not surprisingly that obviously energy consumption and GHG emissions is probably the first lever that you think about and that you engage on. And then interesting, actually labor practice being the second. I think that's also a testimony to the recent debate around how important it is to engage with in the supply chain, especially with human rights and your labor. And then there's governance and risk management and disclosure. Great. Perfect. Thank you very much for that. Suggest then we go a bit to the how and look at 2 case studies. Right. So we brought you 2 case studies, Paper Co. and Food Co. Hopefully you understand that we can't disclose client details here, but we thought we still make it practical and bring you actual case studies so that we can unpack a bit the value creation and hopefully can discuss some learnings. So let me start with the paper company. So the paper company is a global leader on paper production. They do a lot of self-adhesive products, have over 20% product plants globally. They have 2/3 of their revenues in Europe, 1/3 in the rest of the world. They do also some of the labels, if you think about your wine bottle or the beer bottle. They also do luxury packaging. So if you go and buy a special bag, some of the packaging could come from this manufacturer. They were doing fine. So no impressive growth, but a lot of opportunities for value creation. They had a basic ESG strategy, but not a very differentiated one. So then private equity came in and actually worked with the company to improve that and did a comprehensive work on the sustainability strategy. And so what was done? There were 4 main buckets of levers that were pulled. One around sustainability-friendly products, really doing a customer listening tour, actually, what do our customers need? And there was elements around, plastic substitution, recyclability, carbon neutral paper, right? And sustainable appearance that was really demanded by customers that they had not fully in their portfolio. They had parts of that, but not really comprehensively. And they also did a bit of a benchmarking to competitors, and they saw quite some gaps, and also some opportunities which were not covered yet by anyone. And also just comparing R&D levels, there was really some opportunity to invest more. So that was one that they drove. Then they looked obviously into, we discussed those energy savings, upgrading facilities, installing solar, waste to energy. Those were some of the levers that were pulled. Also looking at raw materials optimization that nicely actually linked to some of the products. And then last but not least, employee safety was a big topic. They had quite a bit some issues. So they started to drive actually health protection measures on plant level. And they started actually with reporting. They were using some of the reporting to those incidences that they actually could find out why there were so many injuries, what was happening. And then, of course, they did trainings and enhanced the frequency and the depth of the trainings and improved policies around that. So I think it's quite interesting and quite substantial how they could reduce the injury rate. That obviously has a direct impact on how you can you work on your products. So you all want to see results, I assume. Maybe show of hands in this room. How much do you think has that achieved in the end in terms of EBITDA percentage points improvement? Do I see 1% percentage points EBITDA improvement? Anyone? 1%? Maybe it's just a shy group, but we're talking about sustainable linked value creation. And I think what we nicely see is actually that there's quite a bit of improvement. But I think I don't see brave hands yet. But do we see 1%? Yeah, 5%. Okay, great. Anyone agreeing with 5%? Here we go. I see some. Perfect. Thank you for giving me engagement. And it's actually, we could identify, and they were driving 3 percentage points EBITDA delta just by sustainability measure. And then there was on top 5% out of risk mitigation. So perfect. And which is actually quite nicely to see that you can drive value with sustainability. And obviously, then really build on that and your value creation story. It was also a very successful exit for the private equity firm. And yeah, quite a nice story. We get sometimes asked, yeah, okay, but that's probably industrials, that particular for industrials. Is it really relevant for other sectors? And what about the S levers? So let me maybe dive into a bit of an S example, which was focusing more on the social side of things, which is our food co, which is our private equity-owned leader in food retail. They have, think about the mom and pop stores, shops that you have on the way. As you go to work, you buy your cup of coffee or water, newspaper, probably not that much anymore, but magazines. There was a large chain in Eastern Europe that ran 5,000 franchisees and drove quite significant revenue with that. They had some challenges around consumer preference towards healthy, environmental conscious products, growing importance of sustainability, and attracting and retaining talent. Actually, also franchisee churn was quite high. And those were the key people to drive actually outcome in the shops. And it was a complex product that really didn't fit the needs. So here again, private equity came in with a nice growth story and really looking and developing a nice comprehensive ESG strategy or sustainability strategy, looking at all the different factors. And interestingly, obviously there's some similarities to the industrial company. They also looked at products. What can you improve? Also looking obviously at energy consumption. What I really like with this example when I read about it is that also the small things matter, right? I mean, if you have such a broad chain of retail stores, if you think about exchanging the refrigerator, 2,000 refrigerator can make a difference. I mean, you reduce your carbon footprint by 40% even with those small things because scale then matters, which is quite nice to think through. And here, last but not least, is only franchisee engagement, right? I think there was a lot of emphasis put around how you can engage the franchisees more, drive them, include them in decision-making, invest into career development, and invest into training. They set up a board of franchisees to really make them part of the strategic decision-making of the firm. And they actually really invested quite a lot around that, which gave great engagement and great results in the end, which you also bring here. I don't let you guess anymore, but I'm just going to show you some impressive results that were achieved, and that was at the beginning. So those results just cover the beginning of that company. Of course, there's further involvement and growth coming after that, but just because of the sustainability strategy and value creation and focus also some on the franchisees, there were quite some nice results driven. Right. So I talked a lot now about examples that we saw that resonated with me and hopefully sparked some ideas on some of the elements. Question out to the room, whether there's any thoughts from your portfolio companies, anything that resonated or anything that you would like to share, any examples that come to mind that might be helpful, given we all practitioners here and would like to advance the practice of sustainable linked value creation. Do you have a mic? Yeah. Mic coming.
Hello? Yeah. Right, that's much better. Chloe Sanders, Head of Sustainability at CBC. So this company is one of our portfolio companies, so full disclosure on that. And obviously this was closer to the beginning of the story. But I think we're working very closely with this company. We're always focused on obviously working and continuing to support them with the fantastic progress that they're making. But again, increasingly thinking about how can we demonstrate the value that is coming out of all the work that they're doing. So I was just going to add one additional data point, which is around EcoVadis, which we do use with our portfolio. And this company has a platinum, so they are right at in the top 1% of performers across the EcoVadis universe. And what we found recently is, obviously, correlation is not the same as causation, but we've seen a nice correlation between higher EcoVadis scores and higher DPI. So again, we're sort of toying and sort of playing with the kind of data that we're getting now and really trying to think about how we can actually start to demonstrate and prove that the efforts that are being made are actually producing positive financial outcomes.
Great, thank you. Thank you, Chloe. Any other thoughts in the room? Any examples you'd like to share? Question, please. Yeah, so there was we avoided revenue loss. We calculated there because we had to have an intense management discussion, right? I mean, do you really invest behind some of those sustainability trends, and then thinking through what is actually the revenue that you could lose if you don't follow some of those trends. And we did some scenario analysis around that, and then we quantify that because it's a lot more powerful if you show a quantified mechanism, and then we calculate it backwards. So if you don't invest into these businesses, and if the projections hold true, that the competitors will continue their investments and actually offer these solutions, how much market share would you lose? What would that mean for your EBITDA? Of course, there's a couple of assumptions that need to be made, but in the end, that storytelling helps, because in the end, it's always about having management discussion and really engaging with the portfolio companies, which is not always easy, because there's lots of topics on top of mind. Please.
How do you define healthy products, given that most of the small retailers sell quite unhealthy products, ultra-processed snacks, etc.? So how do you work on that product?
Yeah. Did everybody understand in the room? No.
So just wondering, how did you define healthy products, which is obviously much more difficult to track, define, and work with, given that most of those small retailers sell mostly very unhealthy products, such as the ultra-processed snacks, soda, etc.
Yeah, and it's not that we can solve with, I mean, one retailer can't solve the health challenges that we have. I think healthy is generally with good ingredients, more fresher ingredients, some of less preservatives. I think we didn't have a strict definition, like we're gonna take out all the products that are supposedly unhealthy, but add more healthy one, give them more room, and then have overall a more healthy, more nutritious offering. But point well taken, and rightly, of course, there will be always products which are not as good and healthy. I think we actually often see there's also one way to define it, and it needs to be holding the facts need to be true, especially if you're in your health-focused sector. We just diligenced a company that's focusing on sport nutritions. And it came out in the diligence, and the GP walked away because the sugar levels were too high. So it really needs to work through with your work for your customers, and then also pass the sunshine test. But yeah. Great, thank you very much for the questions and the engagement. Sorry, I think we're getting right at the end, but maybe allow one last question.
Thank you for humoring me. Hi, everyone. Shweta Arya from OP Trust. We're an Ontario-based pension plan. I guess my question is around, could you share a little bit about the size of company and how that matters, right? Obviously, these companies are large. They're hiring Bain to do this work for them, but there's kind of the small guys, the medium-sized guys, and the large guys. And so that obviously matters. And then who is at the table making these decisions? So from a resourcing capacity perspective, who do you really need at the table?
Yeah, a very good question. I think that indeed differs. I think no matter the company size, I think in order to have successful outcomes, you need to engage management, right? You cannot just focus on sustainability team at the portfolio company if there is even one. You need to make these decisions and these conversations part of business strategy. If it's separate, it won't work. And you don't need to hire paid for that, for sure. But you need to get management time and attention. So there is a dialogue if you're sitting on the board or engaging, whatever vehicle you have, and to engage with management to ask the right questions, bring some data points, bring some teasers, so that the dialogue is started, but it needs to start on senior management level. I think very difficult otherwise. And then just having always a good plan, thinking through what you want to achieve, and focusing on a couple of first initiative, and then following it through, just like you do in value creation planning. I think that's probably the same measures that work here as well. Great, thank you. With that, those were the 2 case studies that we wanted to cover. I quickly wanted to end with actually a bit of a preview to share with you what we're going to work with the DTM, PRI, and also NYU Stern School of Business, because we thought we get together and actually help the dialogue, foster the dialogue around this topic, because I think there's so much learning that can be done from different case studies and what others are doing, and to try to understand and disseminate some best practices to share back and actually provide a bit of guidance and ultimately, hopefully, raise the standards. There's an ask for that. It would be great to have engagement of as many practitioners as possible. You see a QR code here at the right-hand side where we have a survey, which would be great to get your engagement. It does take a bit of time, but it's also a good way to reflect, because you can see and get some questions asked on how you drive value creation with your portfolios currently, and hopefully then we can have engagement. There will be workshops coming in, and hopefully more dialogue to come. So thank you very much. And with that, I hand over to Aditya and to the panel to discuss this topic further. Thank you.
Please. Do you want some water?
Okay.
Definitely. Can we have David online as well, please? Thank you. So thank you, Daika, for those insights, those case studies, and engaging the audience. And I think we had a good question there around how the size of company matters and who's at the table. And with that in mind, I'd like to introduce the panelists. And we have made an intention to have panelists representative from different asset classes, from different parts of the world, as well as different strategies. So on my left, Lindsay Gibson from Permira. She leads ESG for North Americas at Permira's, covering both private equity, and Permira is also invested in private credit. John Adler, who's the Chief ESG Officer at the Office of New York Comptroller. Jennifer Coulson, who is the Global Head of ESG at BCIMC and covers across all 4 asset classes, publics and privates. And I don't see David anywhere. But whilst he's coming on stage, we've got David Ferguson Smith from Aqua Capital in Brazil. Aqua Capital is a small investor with less than $1 billion of AUM, and they invest specifically in food and agri. So I think he'll be able to bring the right perspectives from a small mid-market investor. David, welcome. Thank you for joining us. So I'd like to kick off the discussion by asking all the panelists on how they assess the progress that private markets has made on the value creation journey so far, and what do you feel have been some of the key drivers for adoption of this philosophy? Please.
Oh, sure. Good to see you all. I think we've honestly done a really good job over the last few years. I think a lot of what we've talked about in the last few days is giving kind of credit where it's due of how far we've come, but certainly looking forward to all the things we still need to do. I think in private markets, and speaking on, private equity first, there's been a ton of effort in terms of risk management, materiality, thinking about how we, conduct due diligence in a way where we have good visibility kind of going into an investment. There's also been a ton of effort on data collection, especially data quality and coverage. And we're a little bit earlier on, I would say, on value creation. There's some great case studies coming into the market, like Bain just shared, and others, but still a little work to do in terms of being more systematic in the approach. And then I would say just super quickly on private credit, to bring that experience. I focus on private equity, but Permira does have a private credit arm as well. And there we focus on private debt as well as liquid credit. And it's more about risk management, of course, given the level of influence, the type of investment, but there still is a lot of activity going on there on value creation, thinking about instruments like margin ratchets or sustainability-linked loans, but also the value creation from engaging with CLO managers and portfolio companies. So I think a lot of progress, but excited for this discussion on what
Still
we can
more
do.
to be done.
Yeah.
And on that note, John, I'll come to you and maybe understand from your perspective when you work with managers like Lindsay's, how do you feel the LP perspective or the LP demand is shaping the value creation thinking?
So let me just start by saying I work with the 5 pension funds in New York City. We have about $275 billion in US dollars total, and just under 25% is invested in private markets. All of it is invested with external managers. We don't do internal management in New York City. So, and we conduct ESG due diligence on every manager we're evaluating for potential recommendations to our boards. What I'll say about private markets is that I've been pleasantly surprised that the anti-ESG or the ESG backlash that we have all witnessed and have been talking about this week has not really had a dramatic impact on private markets managers. Not the case with public markets managers. I'd say it has had a serious impact, especially on stewardship activity, but our private markets managers continue to be committed to ESG and to deepen their ESG practices, I think consistent with what Lindsay's saying. I will say in general, our non-US GPs, primarily European, have stronger, more integrated and longer standing ESG practices than our US GPs in general. But the US GPs in general are beginning to catch up. So that's a good thing. Most of our European GPs make decarbonization a central element of their investment and value creation strategy. Most of them include ESG projects in their value creation plans for portfolio companies, 100-day plans, if you will. And most also have explicit DE&I goals with regards to gender, at least outside the United States, for their investment professionals and in their portfolio company boards, for example. All of these that I just mentioned are KPIs for our diligence and monitoring for all of our managers. I'd like to focus on two priorities for two different asset classes, real estate and private equity. First, in real estate, private real estate, in conjunction with many of our GPs, we've developed a set of responsible property management standards for residential real estate. And so these are designed to reduce housing instability for tenants and also then improve the long-term quality and sustainability of residential rental real estate investments, while providing sufficient flexibility for the managers to manage investment risks and attain their targeted financial returns. All of our GPs that invest in residential will be expected to adopt these standards for new capital commitments going forward. We just adopted them earlier this year. So the benefits of these standards for value creation include improved long-term investment risk and return through resident stability in residential real estate, preserved and enhanced property values, the tools to navigate new regulatory environments, which are coming sort of fast and furious in the United States because we have both a housing shortage and a housing affordability crisis in the United States, particularly in New York City, but not only in New York City. And related then a decreased potential for reputational risk. These standards are focused on our home market in the United States, and we hope that they will become the standard for institutional investment in the residential real estate market. So that's real estate. And then in private equity, we are in the process of developing responsible workplace principles. So we in New York City have had a whole series of one-off engagements with our GPs over the years on labor issues at their portfolio companies. The idea of these principles that we're developing, and we're not the only ones, a bunch of LPs are doing so, is to guarantee that workers at portfolio companies have the free and fair choice to join a union, freedom of association, the recognition of the rights to collectively bargain, equal opportunity, and a safe and healthy workplace, some of the same issues that Bain presented in their presentation. And our boards believe that respecting these rights and observing these practices creates long-term value by treating employees not as a cost, but as a source of value creation. And that's sort of a fundamental investment belief that we have. Now, we're a pretty big fund. I talked about how big we are. We write pretty big checks to our GPs. So that gives us some degree of influence with our GPs. But we see the benefit of LPs coming together to support their GPs or our GPs collectively adopting high road labor principles as I'm describing. So we're currently exploring with other large LPs and with SHARE the idea of an LP-only forum to identify areas of common concern, develop principles like this and tools, and directly engage and monitor GP performance, with an initial focus on these social risks I've been describing, such as labor rights, residential real estate, property management. If you're interested in this kind of a cooperative approach, I just want to point out Kevin Thomas, who's sitting at the front table here. Please raise your hand, Kevin, who's the CEO of SHARE. You could find him afterwards, and he can tell you more about this work that we're just beginning to engage on. I'll stop there.
Thank you. Thanks, John. And good examples there on responsible property management and how the S side of things can drive things like tenant retention, and being more sustainable and just rental growth over the longer term. So good examples there. Jennifer, coming to you, how do you feel about what John and Lindsay just said, and how do you mirror that in your story and BCI's story so far across the 4 private market asset classes?
Sure. So, Jennifer Colson, I'm with BCI, and we manage about $250 billion in assets under management, largely for public sector pension plans. So we're not a commercial asset manager in that sense. And I would say we started really focusing on value creation, especially in private equity in particular, close to 2 years ago. So we had a dedicated resource embedded in the PE team in New York with the value creation team in order to really look for those opportunities to drive value. And I think, because you had asked earlier about like the impetus for some of this attention as well, and certainly from like a Canadian pension plan perspective, like a lot of us we were at our allocations, right, on private equity. So the focus very quickly went to, okay, well now what do we do with the portfolio? How do we make it even better? So it was just kind of natural that we would turn to value creation as we weren't transacting as often anyway. So I think overall, the industry itself is still relatively early on this. I personally still see a lot of focus on reporting. And sometimes it's just reporting for reporting's sake. Even, we're very much supporters of like EDCI and the like, and that's really important to get a baseline. But I think to really drive this value creation, it's like we need to go to that next step, right? And actually show and demonstrate the GPs and the companies that this really does drive value. But still, I think still kind of early days from
Early
my
days for sure,
perspective.
and great points there about reporting and actually focusing on the right outcomes and right actions. David, coming to you, I think you are in the enviable position of being a small investor, or might be there are disadvantages to it. But if you can tell us about your journey in the two sectors that you work in and your firm works in so far.
Great. Well, here within these two sectors, we're very much allocated within the emerging markets. So most of our investments in Brazil and Latin America. And we have small and medium enterprises. So there's always a challenge of people thinking that we're too small. How can we implement this? So we really work on engaging with the portfolio companies to identify these opportunities, help the portfolio companies really implement and professionalize themselves so that they can create value with ESG. And I feel that the market itself, as the others were mentioning, there's a very strong focus on reporting. So the RLPs are obviously raising the bar and always very keen on how we're reporting things. But there's a very good engagement within LPs to help GPs improve their stewardship systems. So with technical advisory, so there's a very open flow of conversations there. And with other GPs around, we see that there's a lot of curiosity and really intention of understanding how to create value. What are the other competitors doing? How can we support each other as well? So I think it's very early stage, but I think we're really on the right track and we're giving the right steps to get there.
Thanks, David. And we heard two speakers there speak about reporting, and rest assured, PRI has taken notice, and we are working on reducing the reporting burden over the coming few years. If you have more questions, please reach out to our colleagues at the PRI stand. But diving deeper into this topic, and now I would like to focus on your firm's current state of play on ESG value creation. How do you go about doing it? How do you integrate the thinking across the deal life cycle, diligence, financial analysis, integration, 100-day plans? And what are some of the key levers that you focus on? Maybe, Lindsay, more relevant for you to begin.
Touch on, there we go. Kind of how we integrate across the deal life cycle. So, of course, starting with diligence, we've strengthened our ESG diligence approach over the last few years. Again, kind of going from that risk management, materiality-based approach, which is still very much core to what we do, but thinking, what are the additional kind of lenses and topics that we can look at earlier stage to think more from that opportunity perspective. So just to give one kind of example, and there's more of these, but as part of the work with the Sustainable Markets Initiative, Permira's managing partner co-chaired the Climate Change Working Group, and one of their focus areas was valuing carbon, and specifically thinking about valuing carbon in diligence. And so we started with piloting, kind of considering regulated carbon costs. Now we're expanding that to think about, underwriting decarbonization and what that can look like. I'll certainly caveat it's earlier days. It's not relevant for all companies that we look at. But things that we've been able to do, for example, is look at customer contracts and say, how many of your customers have validated science-based targets? How many of them are asking for specific data from you? And so that we can really look and try and measure that and underwrite what it might take for a company either to be in compliance or to set a target, whatever it may be. Quickly kind of on the hold period in terms of levers, picking up on the carbon piece, we really do see climate change and sustainability as one of those macro trends that is impacting the value of companies, whether that's through potential revenue top line gains to be had, reducing cost of financing, exit optionality. We really see our job as making sure our companies are on the right side of that macro trend, and that looks and feels different. Generally, we have a pretty asset-light portfolio in tech and services, especially in the U.S., which are the companies that I work with. But that can be things, again, like looking at their customer base, or if they're in manufacturing, which we have in healthcare or in our consumer sectors, there's a lot to be done on decarbonization of their manufacturing sites, and we've had some really good successes in those sectors. So I think it's really about being more proactive and using diligence as a springboard for value creation to engage with management teams, to engage with deal teams, so that when we go in, we're really eyes wide open on what we can do, and we can front load that work as much as possible so that by the time we go to exit an asset, we can really demonstrate all the work that we've done over the hold period, hopefully see some of those wins actually coming through in terms of revenue growth or cost, so that next buyer feels really good about what they're purchasing, and we might also, get a premium there at the end.
No, great points there around, front-loading the work at diligent stage, and also using the tools of engagement and active ownership throughout the deal life cycle all the way till exit, creating value for the next buyer as well. David, if I may come to you now just to contrast your experience and how do you echo or implement some of the points that Lindsay mentioned in your fund in the sectors that you work in?
Well, we've also included ESG throughout the entire life cycle of the investment. So we have a very strict due diligence process. We've included a tool to assess climate risks within the deals. So we're managing to identify what that would look like in the company's EBITDA, costs, and revenue, which is a very good tool for us to understand the risks that we're going into. And our main action, where we have the most work, is when the portfolio company is inside our portfolio, and we work together with them. And we work within 4 levers of creating value with ESG. And first, we go into what we call aim and do good business. It is how we identify the sustainability of the core business of that portfolio company and how we can expand it, how we can transform it into something that's very much addressable to creating value within commercial side and thereon. The second pillar is to ensure that we have world-class ESG across our portfolio companies. So ensuring that we have best risk management in practices, top certifications, so that we really have a professional ESG side within these portfolio companies. And we see that this really helps us on the exit side. Our last 2 exits, we had top performing companies within EcoVadis. So we're sure that that really is a lever of value creation. Our third lever would be the implementation of bottom line environmental projects. So here we help companies identify and implement projects that are financially feasible, so with over 30% IRR, and environmentally benefit as well. So we have portfolio companies that managed to have really good savings, which were 5% of EBITDA, managed to reduce 40% of their emissions. So we really focus on that as well to show in numbers how we're creating value. And the fourth lever would be on more of the social side, on how we're capturing positive impact, making them better for the employees, engaging employees, talent retainment, works within our supply chain as well, within small farmers, increasing their productivity, and all of that to reduce costs, operational costs, have better quality of our products, and so on.
Sounds good. Thanks, David, and thanks for sharing with us the 4 pillars of your value creation model and how you go about implementing those. Jennifer, if I may come to you and hear about how you implement this in your internally managed assets, and is there anything that you'd like to share there?
Yeah, honestly, it's quite similar. So try to be succinct and not repeat a lot. But again, we just started doing this in private equity, less than 2 years ago. So it's really has been like looking at our processes and how we get this going at an early stage for sure. So I would underscore that. I mean, generally with our investments, it's like there's a deal alert stage, and then you get approval to go away and do more work and come back with your investment memo for final approval. So it really is flagging those things at the deal alert stage that could be problematic, and whether they are appropriate for value creation, because you might decide that they're not, right? It's either too costly, it's too risky, reputationally there might be issues, etc. So it's flagging those at an early stage tends to be the best way, right? Before everybody falls in love with the deal that they're working on. So much more effective. And then, in terms of operationalizing, if there are issues identified and it's in the 100 plan, I mean, it's just working really closely with the kind of traditional value creation team that we have in New York, and getting them to understand that this is not something separate, right? Like this is part of value creation, and then figuring out how to go about it, right? Is it a board level discussion first? Is it getting right in there with management and kind of collecting the data that you need and figuring out, how much it's going to cost to drive certain initiatives? But you obviously have to have the buy-in from management, and you want to make sure that you're not approaching it too kind of, I don't want to say finger wagging or, I'm here to kind of tell you what to do and run your business, right? These people know their businesses really well. So you do have to be sensitive to that dynamic. So really presenting yourself as, an extra resource. We're here to help. And with us, we work a lot with middle market GPs. Which actually is a big opportunity as well, because many of them do not have ESG teams. So again, they see us as a resource that they can draw on. So it's a bit of a value add that we can offer to them that maybe they wouldn't otherwise have. So I think those are the additional points.
Yeah, great points about supporting and working cohesively with the management teams as well. And then John, finally to you, and I know you work with external managers, so maybe from your perspective, what are some of the engagement guardrails or some of the incentives that you provide to managers to drive them towards doing some of the actions which the GPs have spoken about?
I'll say a couple things. First, on climate, three of our 5 boards have adopted net zero objectives by 2040, so quite ambitious. And one of the ways that we're seeking to implement that is that we are saying to all of our GPs that starting next year, 2025, all the funds that these boards invest in are to have their own either net zero or other decarbonization plans as part of, with a written plan as part of the fund. So effectively, if a GP comes to us or comes back to us for a re-up, and they don't have a plan in place, they're going to have a hard time getting money from our boards. So that's one incentive.
Hard incentive.
Right. And, in general, that's what our boards do, is we say, these are the kinds of funds or managers or investments that we want to make. And so, on the issue of responsible workplace principles, once that is in place, and by the way, again, we're in an iterative process with our GPs on developing these principles. It's not like an easy, straightforward process. It wasn't on the responsible property management standards either. We are in dialogue with our GPs and say, okay, this is what our boards want. How can we make it work for you and for them, and sort of thread the needle there? So that's kind of what we do, is we try to iterate with our GPs and say, okay, this is what our boards want to do. How can we work with you to make this work?
I'm glad you mentioned the engagement and the iterative process there.
Yeah.
It makes a lot of sense.
Yeah.
And sorry, so moving on, I wanted to, and I'm very mindful of time, so just wanted to talk to you about, the journey isn't easy. If it was, everyone would be doing so. So what are some of the challenges and issues that you face? You mentioned around convincing the management teams, or working with GPs. So would love to hear from both an LP and a GP perspective. Please, Jennifer, if
Me
you may.
first?
Yeah.
Yeah, I mean, maybe we're too early. so I haven't actually seen a ton of challenges. I mean, obviously, it's always hard to quantify some of this stuff, right? I mean, we hear this in other work as well in ESG. And some of the costs are, you're making some assumptions, especially when it comes to, human capital. How do you put a price on some of that? So the quantification aspect is certainly, not straightforward. But again, if you're in there, you're with the management team and they've seen, maybe how things have gone wrong before, there's going to be some costs there that you can look back historically and kind of, make some good judgments on. And then I think other than that, I would just say it's just cultural, it's education, it's bringing along people within the organization. Again, in PE, it's like they're used to a very traditional model, right? And so they're not necessarily accustomed to talking the language of ESG. So again, bringing this back to how this can make the company more money, or how you can save costs, how you can develop new products for new markets, like just speaking their language as opposed to kind of our usual ESG language, and just throw out some of the terminology, very easily resonates. But sometimes that's just a bit of a process to make sure everyone's kind of on the same page. And then just navigating within the portco. Right, it's like who is really going to support you on this, right? And kind of bring you the data that you need, because sometimes it's a bit of a lift in terms of getting to the right data sources. So maybe those are just three kind of high-level ones.
No, definitely, and the great point that you brought out was the stakeholder matrix and how you need to speak their language to get them excited about it. Otherwise, probably you won't get the deal team's attention.
Yeah, you'll just get the eye roll.
Exactly. Yeah.
Yeah.
We've all seen
Sorry,
it.
please go ahead. Yeah.
I'll just add one on that. Exactly, completely agree with everything you said. I think one I've noticed quite recently working with some of our companies is actually, the sustainability person, if there is a dedicated person, they're often kind of maybe a mid-level manager, right? They're not often, in my experience, sitting in the C-suite or even necessarily right below the C-suite. They're maybe like 2 levels below. And so we have kind of talked on and on about board engagement and C-suite engagement, which is so important. But you actually realize there is a bit of a disconnect with that person and where they sit in the organization, and maybe honestly quite a lot of discomfort with going to their boards or C-suite. So I think we've learned a lot about having kind of champions, whether that is, the deal partner that's sitting in the boardroom, or, working with whoever the sustainability person reports into to kind of bring them into that conversation. When you're asking, for example, for $100,000 on your budget when last year you asked for 0, that's a hard conversation. And they need support in doing that. So recognizing, kind of to your point, on where they sit in the organization, how to navigate the portfolio company, and giving them what they need to really, go up and be able to engage with that group.
Thank you. David, coming to you on this point, and I wondered what your perspective was, given the small investor space that you operate in.
Yeah, I agree that we have the challenges of speaking the language. There's a lot of challenge with smaller companies of you only bring examples of big companies. So are we mature enough to manage to do that? Do we have enough capital to invest in this? So it's always a little bit of a challenging conversation at first, but there's a very good opportunity because it's easily for you to navigate and identify these opportunities. So there's some very quick wins that we managed to identify, and we managed to talk to the right people and demonstrate. So there's a very good opportunity of making it easy for us to navigate a smaller company than a bigger company. And the actions are much quicker. So we really managed to take advantage of that within our portfolio.
That you mentioned, the agility that comes along from being small. I would like to stop here at this stage. I'm mindful that we wanted to discuss a lot more, and there's not enough time, but I'll open the floor for questions, and I'm happy to do it the old school way. If you have questions, just fire it up, and we'll try and respond. Please, go ahead. Do shout, I'll repeat it.
Awesome. So we're speaking about value creation. So how do you quantify value when you're not able to directly connect value creation to financial performance?
So if, for people who didn't hear it, the question was, how do we quantify value and how do we link it to financial performance, and how easy or difficult that is? If there is no clear relation between value and financial performance. Anybody?
Well, I mean, I would just say in our case, like we went through 5 different case studies last year of our direct investments. And that was the exact process that we went through, is like we identified a bunch of opportunities and costed that out and linked it back to, the EBITDA, right? And projected exit multiples. So we were trying to translate that value directly into, what resonates with the deal teams. So like in the case of a logistics company that we were looking at, I mean, we identified $250 million, right? That was just there, right? But without somebody with a lens, around ESG. And in this particular case, it was very human capital oriented. They were really pushing this driver first culture to improve like accident rates for their drivers. So not only did they see improved health and safety, but they also had like a 75% reduction in their insurance premiums. Like it's those types of pieces, and I know it's very anecdotal at this point. I think this is the challenge that we have in PE especially, is a lot of our evidence is anecdotal, but those pieces are there, and it is easy to link a lot of it back to the financials. There's always going to be some that you can't, some more intangible things, but there's lots that you can.
Thank you. I'll take some questions which I have from the room here. Is there a conflict between LP expectations, for example, in terms of portfolio decarbonization or net zero commitments, and the ESG value creation in private companies? And as I think you kind of talked about it a little bit, but maybe, John, for you. Yeah.
I'll take a crack at it.
Yeah.
Is this working? Yeah. Okay. So look, everything that we do has to be consistent with fiduciary duty, right? We are fiduciaries to the participants and beneficiaries of our fund. So we have these decarbonization goals, but they have to be secondary to the imperative to make targeted returns. So we're not saying to our GPs, you must decarbonize at the expense of profitability or value creation. It's got to be consistent with value creation. So we're not asking anybody to take steps that would undermine profitability or value
or in
creation.
sensitive sectors.
Say it again?
Or in sensitive sectors. So, for example, healthcare or some other sectors.
Correct.
Yeah.
We're not. Sorry, this thing is a little annoying. Right. We're not creating mandates that conflict with managers' duty to achieve their targeted risk-adjusted returns. And so that's absolutely fundamental. That's a bedrock. And truthfully, you may or may not know that our pension funds, 3 of them divested from public fossil fuel reserve owners, publicly traded fossil fuel reserve owners a few years ago, and we were subsequently sued for breach of fiduciary duty. And that lawsuit was dismissed, although the plaintiffs had recently filed an appeal, so it's not done yet. But we are under a microscope. And so we're very, very careful that we don't ask anything of any managers that would conflict with their fiduciary duty.
And maybe, Lindsay, I'll ask you the flip side, like what's your experience been with LPs in general, and John's probably on one side of the equation, and how do you deal with these discussions with LPs when you have when you're trying to drive value in portfolio companies and there are certain asks or expectations where you might need to have a conversation?
Yeah, absolutely. I mean, I think for us, it really comes down to prioritizing the right companies. And, Permira has a validated science-based target covering our portfolio. So not only is it a priority for many of our, LPs, it's also a priority for us. And so really, one, that goes out, decades, which is somewhat intentional, but we do have, our first target is for 2027. And what we've seen, though, is for companies that are kind of at the right maturity level, are have the economic kind of incentives that are aligned to decarbonize, whether that's through the OpEx savings, the revenue growth, the customers, all of those different drivers. We're seeing our portfolio align pretty well with that science trajectory that we've committed to through our science-based target. So it's a lot of work. There certainly are companies where we have a discussion and say, it's not the right time for them, and they'll be later on kind of in terms of our list. But we do feel like there's enough companies in the portfolio, a ton that can be addressed today, where it's really not a trade-off, and it very much makes financial sense for them to be decarbonizing.
Thank you. I'll take another question from the Slido, and this is an interesting one. So somebody's asking if you can share experiences of how you were generating excitement amongst your portfolio companies on ESG value creation as a strategy. And which of the strategies from push versus pull work better, or both? I don't know, whoever wants to take it.
I mean, I just say that's an easy one because it's what I said before. It's like you translate it into dollars and cents, and that gets a value creation team pretty excited, right? I mean, that's what they are driving towards. So again, putting it into their terms, their language, try to show that this is going to improve the exit multiple, that gets people excited, right? Going to a portco and having to ask for, another report doesn't get people very excited. So it's dollars and cents.
David, do you want to take that as well?
Yeah, of course. One of the things that we do to get people excited here, especially with portfolio companies, is that we have a lot of gathering of them. So we have value creation days. So twice a year, we bring all the portfolio companies, have specialized forums, and we feel that the companies, they're quite competitive here. So if you show that one's doing very well, the other one wants to be there as well. So you have this healthy competition within portfolio companies that gets them very excited. And of course, our management, the whole firm is very excited about ESG. So we really push that into the portfolio companies. And even before the deal, we already show them that this is important and get the deal very excited as well. So
maybe the next question for Jennifer and Lindsay, and this relates to private credit, where the ask is if you have any examples of value creation on the private credit side, given the nature of the asset class, and given probably less levers that you can use on the stewardship side.
Yeah, no, exactly. Less levers is exactly the way to put it. So the best leverage that we have with private debt is just, before we make the commitment, and, the ability to kind of shape what the instrument looks like. And, it seems okay to talk covenants again these days. So there have been examples where we've been able to kind of alter the covenants that are part of the loan that would reflect some ESG pieces. But I would say it's few and far between at this point. I don't think it's even broaching.
And is there a
common
difference
practice.
in your experience between the private credit versus the public bond landscape in the same?
Yeah, I mean, versus public, I mean, it's just so different. because obviously we do both. So we do a lot of engagement on the public side, and you can have this ongoing relationship with companies. I mean, you do your diligence ahead of time, but then once you own the company, you get to vote on the board once a year, maybe some compensation and shareholder proposals. There's many opportunities to engage with management, but I would say it's in a more superficial way in many ways compared to what we can do on the private equity side, where you can really spend a lot of time with management and really dig in and develop that kind of deep relationship and like a real partnership, right? Whereas I think in the public market sometimes it's still very much like us and them, as much as you try to fix that. I think there's not enough touch points, even if you're meeting 2 or 3 times a year as a public shareholder. So yeah, different levers for many different asset classes. So it'll be interesting to see if there's more innovation in the private debt space and more covenants. I don't know.
Yeah. Lindsay, your take on that?
Yeah, I would just say, and our head of ESG private credit is sitting in this room, so really speaking on her behalf. But, for us, the main tool in private credit really has been margin ratchets and using those kind of tools to engage with the company, whether that's things like, reporting on data, setting targets, achieving certain scores. And we've completed 9 to date, so I think we have more hopefully coming. But it's very different, right? And the level of influence is very different. It's much more of a pull than a push.
Thank you. And I finally saw this question come through, but in a different way. But how are you leveraging technology to support your portfolio companies with their sustainability initiatives and with regards to ESG data collection?
Yeah, so that's been a really big push for us in the last year and a half, I would say. Everybody was working off of spreadsheets for sure, trying to collect data from all the portcos. So really, within the last year, we pushed to have everything kind of centralized into one system. Even though some of the asset classes are using different front-end systems, we're using a common system that can then, feed into their specific asset class systems. So that's been a really big push, as I say, because it's the data, I don't know, minefield really across the organization is very challenging, right? Especially when we grew very fast, and so just different teams were doing different things. So it really was kind of trying to centralize everything, but then make sure things were compatible with asset class specific front end systems. And that way, everyone has access to the data, so you can very quickly, you're hopping on a call with a portco, you can pull up that data really easily instead of, trying to dig through files and spreadsheets. So yes, the visual dashboards and things like that is kind of the way we're going.
John, maybe your perspective on this, given that you might be dealing with a lot of managers, how do you deal with the data challenge there, and how does technology, if at all, helps you?
Well, we have our own ESG data questionnaire, which my guess is your shop has filled out and probably groused about. And I know for GPs, this plethora of ESG questionnaires is a problem. We're looking for a solution, and there isn't a ready-made solution out there. So and we don't have a large budget to purchase advanced technology to do it. So I don't really know the answer, to be perfectly honest.
Fair enough. We are working with a few LPs on a part of the solution, whereby we are trying to see if LPs can converge around the minimum set of climate questions that they might ask of their managers. So be tuned, and we'll speak more about it in the months to come.
Great.
Lindsay, what about yourself on using technology for data challenges?
Yeah, it's imperfect. I'm sure, as many of you can understand. We also, similarly have a huge effort to, have it all kind of in one system. But we've really found we have a ton of great sort of specialist tools. You know, we have the tool on climate risk, we have the tool on portco monitoring, we have a tool on data collection, but how to actually bring these things all together and show. I would love if I could, you know, pull up a dashboard and see all of these various kind of data points and features of a given company. We don't quite have that yet, but I'm hopeful. So.
Thank you. Very mindful of the time, so if we can bring up the Slido for, I think we have one last question there, which is just to get the temperature of the room on how, sorry, the Slido poll, sorry. There you go. Thank you. And once you are kind of having a look at that, I would like to thank all the panelists, including Daika earlier, for sharing insights. And we've heard a variety of messages, all of which reinforce the use of ESG as a tool for value creation in private markets. We heard about engagement with portfolio companies. We heard about CapEx, capital allocation, frameworks, bespoke models. We heard about responsible property management, workforce standards. We talked about EBITDA bridges, putting a value to your value creation efforts. And I hope it gives you a flavor and taste of how you can use ESG and begin your journey as well if you haven't already, or you make progress if you are already doing it. And if there's one message that I would like you to take away from here is that we are all leaving a lot of value on the table with respect to ESG. And I think the more we talk about it, the more we work actively on it, the more we can progress together. Thank you all.